everyone, this is your review video for your Unit 2 graded assignment in AC201. And in your assignment, you're going to be asked to take a bunch of information and produce an income statement, a statement of retained earnings, and a statement of comprehensive income. In this example, we're going to do it for a company called Marlin Guitars Incorporated. They are a publicly traded retailer of guitars. From their founding until 2017, Marlin Guitars operated two separate divisions, the acoustic division and the electric division. But due to a decline in sales, Marlin has decided to discontinue operations of their acoustic division in December 2017. So now we have a portion of our income which can be attributed to an aspect of our business which is not existing anymore, and that is called a discontinued operation. In our income statement, we need to let our investors know, yes, we made this much money, but this portion of that money came from something we're not going to do next year. We also have the following information that's going to be useful to help us prepare our income statement and statement of retained earnings for the year. We have an outstanding long-term note from a local bank, so we're going to have to just declare some interest expense somewhere. We pay our sales personnel a base salary plus commission. Okay. We conduct the entirety of our operations out of one location, which means it's nearly impossible to allocate the use of supplies, stationery, and postage between what went to selling and what went to administrative. So we need to display those two separately on our income statement. We have to have our selling expenses, we have to have our administrative expenses. How are we going to do that? Well, we're going to use this policy that we're just going to split it equally down the middle. We own a building that is adjacent to our headquarters, and we rent it to another company. This is the only rental property that we own, which means we have rent revenue. But since that's not part of our normal operations, we can't put the money from renting into our operating income. We're going to have to declare that as an other. We own a controlling interest in another instrument retailer called Gibbons Guitars. We, in fact, own 80% of Gibbons, which means since we own more than half, we have to consolidate. We have to take Gibbons' income and roll it right into ours like we're one entity. But we don't get to have all of the money, all of the income that Gibbons made. Gibbons had $200,000 in income from continuing operations, which means since we own 80%, that other 20% is, entitled to somebody else, and it's called a non-controlling interest. So we're going to have to show users of our information what portion of that income is attributable to these people that still own 20% of Gibbons Guitars. We are taxed at a 30% rate, and that's useful for a lot of things. First, we need to have our income tax expense shown, but secondly, we have discontinued operations, and when we display the numbers for that, we're going to have to display them net of tax. We have 500,000 shares of common stock outstanding, which is going to be very useful when we have to calculate our earnings per share, because if it's per share, we need to know how many shares we have. We had a retained earning balance of $12,400,000 at the end of the prior year. That's what we put on there. But we had an error, and it happens. You make mistakes on your books. Somebody made a mistake with an amortization error, which caused our net income to be understated by $210,000. So they recorded an extra $200,000 worth of amortization expense, which shouldn't have existed. And we can't just leave our books being wrong. So we need to change that up on our current books, which means we're going to have to make a thing called a prior period adjustment. Next, Marlin Guitars is restricting $250,000 of retained earnings for the purchase of new office furniture and equipment. Okay. Well, what gets paid out of retained earnings? Dividends. Our shareholders are going to know how much money they are eligible for. And if we're restricting some of that, we can't give it to our shareholders. So we need to disclose that information to our shareholders, that not all of our retained earnings are available to be distributed. We paid a 60-cent per share dividend to common stockholders during the year. Okay, we're going to be able to use that information when we have dividends paid on our statement of retained earnings. And lastly, we had some unrealized things. We had an unrealized holding gain of $30,000 on an equity investment, which is appreciated, and we had an unrealized gain of $50,000 on a note receivable due soon from a foreign company. In accounting, when the exchange rate, changes between currencies and you're getting paid in a different currency, well, it's possible that you get back more money than you thought you would because the exchange rate is favorable. That's what happened here. And that is called a gain from a translation adjustment. Both of these numbers are represented in net of tax. Wow, that's a lot of information, and we got even more. We got a bunch of stuff down here that we need to figure out what to do with. It's the information we're going to need to prepare these 3 financial statements. So let's break this down piece by piece. In our income statement, we're going to break it into different sections, and the sections are listed in that green box on the side. We're going to have a sales section, we're going to have a selling expense section, we're going to have a general and administrative expense section, and we're going to have a research and development expense section. Then we're going to have our others, things that happen to our business outside of our normal course of operations. If it's good for us, it's an other revenue and gain. If it's something that's going to decrease our income, it's an other expense and loss. And lastly, we need to decide if something is a discontinued operation or not. So let's go through and figure out where everything goes. Sales revenue. That goes into our operating sales section. And in the operating sales section, what we're going to display is all the things that are related to sales that aren't necessarily expenses. So if we gave a discount to someone for paying promptly or for ordering a large quantity, well, that would go in that section. If they returned goods to us and we had to refund their money, that's going to go in that section. And then lastly, we had to pay to produce or procure those goods that we sold. So cost of goods sold is going to go in that section. So sales discounts goes in the sales section. Sales returns and allowances, yep, that's operating sales as well. And cost of goods sold is also going to go there. The next thing we have on the list is sales, salaries, and commissions. Well, that's what we're going to pay the people that sell our guitars for us. And that sure sounds like a selling expense to me. So this is going to go under our operating. Sorry, let's fix that. This is going to go under our operating selling expense section. Next up, we have supplies, stationery, and postage. That is also going to go under our operating selling expense section. We have our depreciation, and this is on sales equipment. Well, since it's on sales equipment, that is a selling expense. And then other selling expense, you can guess, is going to go into our operating selling expense section. Next up, we have our officer salaries, and they're the people that run our company. So that is going to go into our operating, and I'm going to call it G&A for general and administrative expense section. After that, we have our supplies, stationery, and postage that our administration is using. Well, that's a G&A expense, general administrative. If our administration is using it, it has to be an administrative expense. We have depreciation of office equipment. So this is used by our administrators. So that's going to be operating G&A as well. And then we have other administrative expenses. Again, has to go into general and administrative expense. Then we have research and development expenses. Well, I'm sure you guys can figure that one out. That is going to go into our operating R&D expense section. Rent revenue. Again, we are guitar manufacturers and sellers, which means that we're in the business of renting out property to other people. So since that's not part of our normal operations, that is going to go under other revenues and gains. Then we have interest on notes payable. And interest, even though lending is a typical thing of operations, is always going to get listed under your others. So that's going to go under other expenses and losses. Then we have the income from our acoustic division and our loss on the disposal of the acoustic division. We're getting rid of the acoustic division, which means these have to be reported as a discontinued operation. And with that, we are going to be ready to go to prepare our income statement, which we'll do in the next video.